Hi, I'm Brooke Dockery. Welcome to What's Hot and What's Not in the month of May. I'm going to start this video by talking about sell in May, since we're at the beginning of May. Usually at this time of the year, we see the media come out with articles about sell in May, and usually they say, well, maybe this year it won't work because last year it didn't work because the S&P 500 was up slightly, or the year before it didn't work because the S&P 500 was up slightly once again. They're missing the point about risk-adjusted returns and exposure to risk. And I'm going to talk a little bit about that in this video today as well. We're going to talk about what sectors tend to do well in the month of May and what sectors also tend to perform poorly. We're going to be using the Thackeray's 2023 Investor's Guide. It's a shameless plug for my book, of course. And well, let's jump right in and start taking a look. First of all, let's take a look at the average trend for the S&P 500 in the month of May from 1950 to 2022. You can see here the first few days of May tend to perform okay. In fact, that's why I start my week period for the market, 6-month week period for the market on May 6th until October 27th, because often you'll see the first few days of May tend to perform well. And you can see that down here in the bars. These are probability bars or frequency bars, I should say, of how often the S&P 500 has been up on the trading days for May. You can see here in the first few days, they're above 50%, and then we can see here they start to go down negative, not negative, but lower than 50%, and then all the way across here, they seem to be a little bit weaker, at least until the end of May. So typically what you see is the first few days of May tend to perform okay, and then you start to see a little bit of weakness in the market until later on in the month. Now, if we take a look at the sectors of the market that tend to perform well in May, healthcare is at the top of the list here. But I want to talk a little bit about this last column here, because this is important. It's not just all about gains. It's about frequency of returns being positive and also outperforming the S&P 500. These are the major sectors of the S&P 500 here. You can see here that in this case, they're really around 55, 60. Well, do we have any 60s here? We actually don't have any 60 sectors outperforming the S&P 500 60% or above in the month of May. And we don't see any, most of the sectors are actually around 50%. We do see a couple here. We see materials only outperforming the S&P 500 36% of the time in May, and also the energy sector 36% of the time in May. So we don't see really strong sectors that have a major sectors of the market tend to really strongly outperform the S&P 500 in the month of May. And so if we take a look here, but on an average gain basis, we see healthcare at the top of the list here. From 1990 to 2022, it's produced an average gain of 1.5%. So what that means is, and this compares to the S&P 500, which in this month has produced, overall month has produced a gain of 0.9%. This is basically saying when the healthcare sector does particularly well, it does particularly well in the month of May, even though it's just outperformed the S&P 500 just over half of the time. The consumer staple sector tends to perform well once again. So we're seeing a little bit of a theme here where the defensive sectors of the market tend to perform well. That's in the transition time. So here we're transitioning into the weaker 6 months of the year. And if we take a look going down here, we can see the utility sector, which is also a defensive sector, quite far down the list. And that's quite interesting. And investors tend to move into the fixed income government bonds sector rather than utilities in the month of May. If we take a look at some of the other sectors here, technology tends to perform well in the month of May. And we've seen the technology sector actually perform well. This is perhaps skewed a little bit by some of the returns that have been made in the technology sectors over the last few years as the market has been in a rally here. But the energy sector, let's come to that, well, the material sector. So we're looking at, in this case, chemicals makes up about 70% of the sector in the U.S. for materials. And what that's telling you is investors tend to get concerned about economic growth. And that is true this year as well. There's a lot of concern for economic growth in the marketplace, talk about hard landings, recessions. And as that happens, you would expect to see the material sector to underperform if that were the case. And so we do see the material sector on average at this time of the year underperforming. The energy sector. Now I want to talk a little bit about the energy sector. It's in the news a lot, particularly in Canada as well, because it makes up a large part of the market. The energy sector tends to perform well from February, sometimes January into May. But in a strong bull market, if the energy sector is in a strong bull market, you can see the energy sector perform well into June. And we've seen that in a few years where we've seen the energy sector perform well into June and then start to roll over. Sometimes so it gets a little bit more life than normal, but on average, May tends not to be a good month for the energy sector. And the energy sector has been bouncing around here, so I wouldn't call that a particularly strong bull market, lots of volatility. So be careful with the energy sector. We could see some problems with that as well. I want to jump down to some of the selected subsectors. Look at the biotech sector. Biotech sector starts its seasonal period in June, but we can see the sector do well in May. June tends to be a strong month, and July is extremely strong on a seasonal basis for the biotech sector. So, but watch out, the biotech sector could start to perform well later, particularly later in the month. If it starts a seasonal run, it's usually a little bit later, mid-May to late May. Here we go down. Semis can actually perform well on just like the technology sector. If we go down to some of the sectors at the bottom here, gold, silver, and gold, about half the time, a little less than half the time, they tend to outperform the S&P 500. Not particularly strong results, so they tend to be at the lower level. I want to point out this sector here, though, the auto sector. Look at this sector here. 27% of the time it's outperformed the S&P 500 in May. That's not a good result, and on average it's been negative in that time period from 1990 to 2022. So, and if we have concerns about a recession, this is typically when you start to see the auto sector get hit. So be careful with it. So really, we're looking at some of these higher and lower numbers to say that, here's probably a sector that could do better in May. They'll start a seasonal period in June, but could start early. But be careful with the auto sector this particular month. Let's flip over a couple pages here, and let's take a look at some of the seasonal trends. I talk about Disney. I want to bring up Disney. Now, I do bring up shorts in my book, Sell Short Periods, because I know most investors aren't going to do that, but I want to point out these periods because it's a period of weakness that perhaps might represent an opportunity for those investors who are so inclined to take a long position if they do see an appropriate correction. So we tend to see Disney actually perform poorly from June 5th until September 30th. A lot of that has to do, first of all, the consumer discretionary sector doesn't do well in this time period, and also, too, just the way the revenues throughout the year stack up for Disney and investors' anticipation of that. So something to watch out for, and I've got the stats here in my book here as well. And you can see here in that period from 1990, we've only seen the Disney sector be positive about a third of the time, and it's actually lost money in that time period. So it could be a great company, but this is when these companies tends to not perform well. That's just the way the seasonal trend is for Disney as well. And we can see some of that here with the monthly bars for Disney from 2020 to 2021, and going across. June tends to not be such a great month. August and September as well. There's a graph of Disney here, and this is Disney relative to the S&P 500. These blue boxes represent that seasonal period where Disney tends to be weak from June 5th until September the 30th. Just going back a few years to take a look at the performance for this. So in this period, they tend to be weak. Disney tends to be weak. You can see here back in 2020 here, really it was very flat for Disney, and relative to the market, you can see that it underperformed in that period, and it typically does on a seasonal basis. Then we look at 2021, we can see it was slightly down that period and underperformed the S&P 500. So it was actually following its seasonal trend in those 2 years. And if we take a look at the performance in 2022, we can see that Disney was down in its weak seasonal period as it followed the seasonal trend. A lot of volatility, but it did end up down. You can see here that it looks like it just slightly outperformed the market in that period. But overall, Disney has performed poorly in its weak seasonal period, even in the last few years, and relative to the S&P 500 as well. Okay, if we flip over the page here and we go to, now this is the 6 and 6. So this is the sell in May period, and this is from May 6th until October 27th. I want to point out here, so this first set of columns is May 6th to October 27th from 1950, and this is from October 20th to May 5th, okay? And if I've just basically gone down year by year and taken a look at the returns for the S&P 500 in these relative periods. And this last column tells me if the October to May period outperforms the other period as well. First of all, look how often this occurs on a frequency basis here. I mean, this is really what Sell in May is about. It's about stepping on the gas pedal in the markets from October until May. And so far, that's been a good trade on a seasonal basis this year versus the other 6 months of the year. And sure, you can see here, there are some positive returns in this period here. But overall, on a risk-adjusted basis, if we take a look here, and the gains, we're going to start with $10,000. And we invest every year from May 6th until October the 27th. And so what happens? You in and out of the market every single year. And if you go all the way down here, and you do that from 1950, you would have made a total of $1,360. Wow. Okay, nothing to write home about. But if you did it from October 28th to May 5th, okay, so that's a strong seasonal period for the market. Start with $10,000, you would have ended up with $1.9 million, or basically, $2 million as a gain. So huge difference. Now, obviously, there's compounding in here as well, but that's just showing you a different way of looking at sell in May. And this is trying to tell you that in this period here, from May 6th until October 27th, it's typically, you don't get high returns. You tend to find bigger losses and fewer large gains in this period compared to the other 6 months. I go through some of the stats here as well. In fact, if you look at it on a decade basis, every decade, the 50s, the 60s, the 70s, the 80s, the 90s, the 2000s, the 2010s, if I showed you the numbers on that basis by decade, and say, if you only can invest in the S&P 500 for 6 months of the year, investors always choose to invest from October 28th to May 5th, because it's not just a few years that have skewed these numbers here. This is a seasonal trend that's occurred every single decade. Now, we've gone through this really good bull market run recently, from 2009, and with the Federal Reserve pumping up the markets. Okay, and that's even then. The period from May 6th until October the 27th has not been a stellar performer. It has been positive, but it's been underperformed the other 6 months of the year. But and now we have the Federal Reserve, obviously, quantitative tightening and trying to control inflation a little bit. And anyhow, let's flip on to the next one page here. I talk about the Canadian 6 and 6. So sell in May for the Canadian market, and I go from 1977 to 78, and you can see here the difference here. It's exactly the same trend. We see the overall stock market tending to perform well from late October to early May as well. Let's jump ahead and let's take a look at my next page here. I'm going to jump to Costco. If we take a look at Costco here, we can see here from May 26th until June 30th, Costco tends to perform well. You find a lot of the stocks, defensive stocks or the consumer staple stocks tend to perform well in the transition months as we move into the unfavorable season for the stock market. And Costco is also one of those stocks. This is a graph of Costco. This is Costco relative to the S&P 500, this panel here. And we can see here, this blue box represents a period of seasonal strength for Costco from May 26th until June 30th. You can see it was slightly positive back in 2020, but it did underperform the S&P 500. You can see here that it was following that trend downward. Now, don't forget, this was during the COVID pandemic. We saw Costco run up really strongly in 2020, early 2020, and pull back later on. And that was the tail end of that. In 2021, we can see that it was positive in a strong seasonal period and outperformed the S&P 500. And in 2022, we can see the same. It was positive and strongly outperformed the S&P 500, particularly because it had pulled back down here. If we take a look at Costco right now, it is in a consolidation range relative to the S&P 500 and trending up here a little bit on an absolute basis. When we see a consolidation range ahead of its seasonal period, that's typically a good setup for good performance in a seasonal period, and that could apply to Costco this year. So where do we stand in the market this year for the month of May? Well, we've just entered into that sell in May period, and I've talked a little bit about that today, but it doesn't mean that the market's going to go down from May until October. Sell in May really means that the market tends to be weaker this time of the year compared to the other 6 months of the year, and we tend to find bigger drops in this time period as well. And so if the market's not set up to do well, this is the time period where it can actually underperform here. And the best way to think about this is a risk adjustment allocation, really, that takes place on a seasonal basis in May for the markets. And we're seeing some real headwinds for the market right now. Sure, we've seen the soft numbers, the sentiment indicators, the surveys that are done in the marketplace, whether it's the ISM, PMIs, and others that indicate that the economy really is showing some weakness here. The hard data, GDP, for instance, it hasn't been particularly bad. But the soft numbers keep showing, the possibility of a further slowdown in the economy. And there's a lot of talk about a hard landing or a recession here as well. So there's a big discrepancy about what investors believe the Federal Reserve should be doing and what the Federal Reserve is in fact doing. The Federal Reserve is more hawkish than what investors want. So given that we're in this weak seasonal period for the market, and we have the Federal Reserve really pushing against the economy and the market. And there's a saying, don't fight the Fed. And in this case, that means that don't fight the Fed. If they're saying they're trying to slow things down, they're trying to slow things down here. So this is not probably the best time to be taking, from a seasonal basis, a big, huge risk in the market, particularly with the headwinds that we're seeing in the marketplace here. And sure, if the Federal Reserve does pause at some point, in the next few months, we could see the market rally, but be careful what you wish for, because when the Fed pauses in the past, what we've seen is the market, sure, it does okay for maybe a few days or weeks, but on average, what we see is the market pull back because the Fed's cutting rates, and when it starts to cut rates, when it makes its cut, it's doing so because the economy is slowing down, and the cut tends to help. But at that point, the economy slowing down is too much for the Federal Reserve to counter. And then we see the stock market react to that. And we see the stock market actually pull back on average after the Fed starts to make its first cut. So we're in this position right now where really there's a higher probability of the market struggling this year from May until late October than we've seen in other years recently. And sure, there are going to be pockets in the market where we could see the broad market perform well. Now, I talk about that in my book. From late June into mid-July, the stock market can move higher, coming into earnings season in particular. And that's a seasonal trend that takes place. And there's a lot of different sectors of the market that can do well in this time period as well. So it's not just sell in May, go to cash, go fishing, and come back in October. There are opportunities along the way. It's really, this is a time on a seasonal basis to be more conservative. Thank you very much for joining me today.